Why is it dangerous to have a target on the day, as in a P&L target? And the reason is this, that if you have a P&L target on the day, what you end up doing is limiting your upside, and particularly this is bad, and this is the real danger in it, where people don't have a downside. People often go through this kind of idea of, right, well, I can pull it back. So they're happy to go into the hole, but when they get out of the hole, their objective is cap that. Don't let myself earn any more money. And that's the way you have to think about it. By giving yourself an upside target, you're actually basically saying to yourself, I do not want to earn any more money. That, and nobody else would do that in any other kind of job. And I'll illustrate this with a couple of charts for you as well. Looking at our group's performance over June, July and August, and have a look at what would happen if you gave them a P&L cap. If you said, right, when the day as a total for the group reaches a certain P&L, we are stopping, no more trading. And what would the impact of that be? And it's quite significant. And so what I've tried to do is then break down these P&Ls into a few different types of scenario. So what we've got to start with is a chart showing the performance of every single day since the beginning of June through to the end of August. This shows you how people have performed every single day, so you can see the number of up days roughly and the relative difference between the size of the performance. Now, if you turn this into a line chart, i.e. an equity curve, you get some very distinctly different scenarios if you change some of the restrictions on that. So what I've done then in the second chart is to illustrate what would happen if you had a target on the day and no stop. So if you had the performance to the downside that you got using that data set, but limited the upside, then you would end up with the red line. By the end of the month, you would be extremely flat. And this is the big danger that people face. By having an upside target, you're still exposed to the losses and you still get punished by these losses. But what you can't do is weather them very well because of the fact that you've not made those big gains when the opportunity's there. If you have an equal stop and target, so an even sized upside and an even sized downside, you get the green line. Now, you do get some performance, but it's limited. And this is the point here, that yes, your stop is important to prevent you from excessive losses. But by capping your upside, what you're doing is you're always holding yourself back. You're always limiting the possibilities that you have. And then beyond that, you can have no target and no stop. And that's then the performance that you've got on that blue line. And then finally, if you have a stop and no target, you get the purple. And so you can see the importance of a stop on the day. The stop is there to prevent excessive losses. But what you shouldn't do is then have the same to the upside. You don't want to limit the gains, because by limiting the gains, what you're doing is you're making every stop out day more significant. So you can have a losing day, that's fine. But if you're not having a very good up day when you're up, what you're doing is you're making that losing day so much more significant. And that's the big trap that people fall into. You often hear the phrase in trading, you won't go broke taking profits. Possibly not on the day, and on the basics of that, well, of course, you can't lose money if you're taking profit. But what that doesn't do, and what it doesn't help you with, is dealing with the days that you do lose. Of course, you can't go broke if you take profits, but the way you do go broke is if when you lose, your losses wipe out those profits because you didn't allow your profits to accumulate. So don't see an opportunity to bank winners and call that a day and hit your goal. Trading is about making the most of the opportunities when they come. You don't know when the big opportunities are going to come, and often those big opportunities can come 1, 2, 3 days in a row as volatility picks up, and that can be your month made. But if you cap that, what it does is it means that the rest of the losses you make during the month are very, very significant. So bear that in mind next time you decide, I'm only going to have a target of this, or I'm going to stop at this point because, I've had a good morning. Think about the opportunities that are forthcoming. You don't know when the best opportunity of the day is going to come, and it could come on the back of what is already a very good day for you. So bear that in mind. I'll see you all in future. We'll be talking a bit more about performance and how you sort of deal with performance realistically from a trader's perspective. What do traders really do? So we're doing a few more of these in the coming weeks. Click subscribe, click on the notification below, and you'll be seeing a bit more of me in future. Catch you all soon.